Here's a strategy that sounds almost too simple, and yet most people get it wrong, over and over. Don't react to the news. Wait for the news to be confirmed. Sounds obvious, right? But if it's that obvious, why did so many people rush in and buy Tesla last week, the second it jumped 8% in a single day on robotaxi news? And why is almost nobody talking about NVIDIA right now, even though it's sitting there, quiet, basically forgotten? So, before we jump into the examples, let's slow down for a second, because if you just memorize the steps without understanding what's actually driving them, the moment the market throws you a curveball, you're going to freeze, and I don't want that for you. Here's what almost always happens when good news drops. The crowd reacts instantly. Price jumps, volume spikes. That's what I call an emotional breakout. But here's the thing. That breakout only proves one thing. People got excited. That's it. It doesn't tell you anything about what the business is actually worth. What really matters is what happens next. The moment real data starts checking that story against reality. If the story holds up, the data confirms it. If it doesn't, the gap between emotion and reality starts to show, and that's exactly where patient people come out ahead, while fast reactors get left holding the bag. And look, if we're being honest, you've probably done this too. Seen a good headline, felt that little rush, opened the app. That's not a character flaw, that's just being human. The real issue isn't that the feeling shows up, it's letting that feeling make the decision for you, instead of the data. So, how do you turn this into something you can actually use? Honestly, it's a pretty simple sequence. First, you filter. Not every headline deserves your attention. Only the ones that genuinely change a company's long-term story are worth stopping for. Then, you watch how the market reacts emotionally. Price spikes, volume surges. But instead of jumping in right away, you wait. And here's the part that really matters. You wait for the fundamentals to speak. Does the valuation actually support the good news? Is the company genuinely creating value here? Are insiders, the people closest to the business, buying or quietly heading for the exit? Only when those things line up do you treat it as a real signal, and through all of it, you stay disciplined. Because no strategy gets it right every single time. Let's start with Tesla. The headlines couldn't have looked better. Robotaxi expanding into Dallas and Houston. A major bank just upgraded the stock. So the natural reaction for most people? Fear of missing out. Jump in now, figure out the rest later. But here's what the numbers actually say. The stock is trading at $420. Fair value, based on Invyra's models, comes out around $267. That's a 57% gap. And it gets worse from there. The company's return on the capital it's investing is only 4.3%, while the cost of that capital is 13.1%. Plainly put, they're burning value, not building it. And when you look at the competitive moat, how hard it is for competitors to replicate what they do, Invyra rates it narrow. Not wide, narrow, meaning those advantages need constant investment just to maintain. And the people inside the company, the ones who know it best, are net sellers right now, not buyers. So the news is real. It's just that the value just isn't keeping up with it. Now flip the story completely. NVIDIA hasn't had a single loud headline in weeks. And yet, here's what the data says. Return on capital is sitting at 70% against a cost of capital of just 15.4%. That's an enormous gap. Financial health checks out 4 for 4. And the competitive moat? Invyra rates it wide, 8.2 out of 10. That means the advantages this company has are extremely difficult for anyone to replicate. Not impossible, extremely difficult. And despite all of that, the stock is still trading 14% below fair value. Nobody's saying a word about it. But the numbers? They're practically shouting. There are 3 traps worth knowing. The first one, chasing the breakout, exactly like what happened with Tesla. The second, reacting to every small headline instead of focusing only on the ones that actually shift a company's long-term story. Not everything deserves a reaction. And the one that quietly does the most damage, having no reference point to check your own emotions against. Without something to push back on your gut feeling, you'll always believe you're being rational, even when you're just following the crowd. And honestly, this is exactly why Invyra exists. Not to tell you when to buy or sell, but to help you see the gap between emotion and reality before that emotion ends up making the decision for you. So next time a headline gets you excited, just take 30 seconds. Check the valuation, check the return on capital, check what insiders are actually doing. That alone removes most of the risk of just following the herd. And here's what's worth carrying away from both of these stories. The stock everyone's talking about is usually the riskiest one to buy. And the one nobody's talking about? That's often exactly where the real opportunity is quietly sitting. The market doesn't reward whoever reacts the fastest. It rewards whoever's calm enough to stop and ask, is this real, or is this just a feeling that's going to pass? And just to be clear, this isn't investment advice, just a personal observation based on the data. Always do your own homework before making any decision. Every number I use today, fair value, return on capital, financial health, what insiders are doing, you can pull up yourself for free on Invyra. No credit card needed. Link is in the description. And if this helped you see things a little differently, drop a like and stick around. There's more of this coming.